Hello, everyone. My name is Phil Hodge. I'm the president and CEO of Pinecliff Energy. We are a TSX listed company situated. Our head office is in Calgary, Alberta, Canada. All of our assets are in Western Canada. We're also OTC listed. Our TSX ticker symbol is PNE, and then our OTC ticker symbol is PIFYF. I would like to take you through a brief presentation on Pinecliff, and then we will have a question and answer session that happy to share some more information about Pinecliff. Here's kind of just an overall slide that kind of talks about Pinecliff and why I think Pinecliff's a pretty good shareholding to have in your portfolio. Our dividend level, we've put a dividend in place in summer of 2022, and since then we've adjusted it three times, twice up, once down. We continue to use it to make sure that we're giving back as kind of over 80% of our free funds flow back to the shareholders. And so we see there's some tremendous opportunities as we see what's happening on the gas front going into 2025, and we hope to be able to be in a position to again adjust our dividend upward. We've got our debt. We had no debt for several years on Pinecliff. We were saving up cash after 2022. We went from $50 million of debt to $50 million of cash flow. We'll talk about that in a minute here. That was, we did a $100 million acquisition in December of 2023. So just a few months ago. And in that transaction, we used up $50 million of our cash. And then we also put about $56 million of debt on the company, which is about, it's actually on a forward strip basis, probably a little less than 1 times debt to cash flow. I think the main reasons that I think Pinecliff is a very attractive is it's got one of the highest leverage to Canadian natural gas that you'll find. And so and we'll talk about it here in a couple of minutes, but we're very bullish on where we think Canadian natural gas is going to be, especially the Western Canadian and what we call AECO. AECO is the price that we receive here in Alberta. That there's a lot of reasons why we think AECO is going to be going into a much more positive and an optimistic time frame here. And so we've really positioned ourselves, just to give you just a tiny little bit of history on Pinecliff, is that I was employee number 1 over 12 years ago. So this is my 13th year running Pinecliff, and we've grown from 100 barrels a day to over 25,000 barrels a day. Primarily natural gas. We're about 80% natural gas, 79% natural gas, and that's we've done that by acquisition, and we've really the thing that we've really focused on was building a platform that had a low production decline. And that why we think that's important is it just gives us optimal ability to allocate capital. And I think that's really what, from Pinecliff, that's what we think we do a very good job of, is allocating capital to where it should be best used, whether it be acquisitions, whether it be dividends, whether it be paying down debt. Those are all the decisions we make. And we're very aligned with our shareholders because we own senior management owns a lot of stock. So it's a bit unique in its model. The production decline really sets us apart. There is the average natural gas company in Canada has about a 31% production decline rate, which means that every single year, if they did no drilling, if they did nothing to keep their production higher, they would have a 30% reduction in their production. We are at about a 9% decline rate, and we're the only single-digit public company that exists. And so it is a unique model, but it's by design that we built it that way. We're right now about a $350 million market cap. So it'd be over $400 million enterprise value with our debt that we have in place. I mentioned the 25,000. I mentioned the 79% natural gas. Our CapEx guidance for 24 we reduced from 23. We just don't think it makes any sense to be bringing on, especially gas molecules, into a more challenged natural gas environment that we're in right now. I think from our perspective, we believe that if, with the low decline rate, that allows us to have that flexibility that others don't have. And therefore, we definitely want to capitalize on that. We talked about the insider ownership. We have one very large insider, which is the AECO, which is the Alberta Investment Management Company. They manage about $140 billion, or one of the biggest pension funds that exists in Canada, and definitely in Western Canada. And they are our biggest shareholder. And then after that, we've, like I say, management owns significant shareholdings, and we always have. That's always been the model. I mean, I continue to, I was buying shares last week in the market. I've never sold a share of Pine Cliff, and that's been a kind of, an important piece to why we think it's an attractive company to be an investor in, is because we're very aligned with our shareholders, and always have been. I mentioned briefly the deal that we did here in December was about 5,300. Actually, it was about 5,300 barrels a day when we announced the deal. It came on at around 6,000 barrels a day because there was a couple of newer wells that were put into it. That it was just offsetting our central Alberta area, so that Ghost Pine area that we call the new assets in the Caroline area, but very close to kind of central Alberta. As you can see, almost all of our assets that are in the province of Alberta, which we think is, going to be a very strategic place to be located, because Alberta is really made some strong moves to increase the natural gas that it uses in our province as we moved off coal, and the very last coal facilities shut down in 2024. So this year we'll see that transition happen from when we used to be 80% of our energy came from coal, just a few years ago. So it was a good deal for us. The Certus, it added inventory, which was really important for us. Even though we don't have a very high decline rate, we still have a decline rate. And so we wanted to add some locations that we could, that would be have high rates of return for drilling, and the Caroline area definitely had that. I think this is kind of our 2024 budget and guidance for the year. You can see the production rate. You can see that kind of from a CapEx standpoint, we would have spent about $29 million last year on CapEx. The one thing that I would always point out is that when we talk about our CapEx, it really includes everything. It includes not just our drilling upside, which a lot of companies just talk about that, but for us, it's also about our abandonment and reclamation. Of that $17.5 million, about $7 million of it is going to be abandonment and reclamation work that we're going to do in 2024. And then also included in that is our maintenance capital, which is probably $5 to $6 million. So that the amount of drilling upside that we've got into the budget for this year is really only about $7 million. And that'll be, we put it in the back half of the year. If it makes sense to drill wells, then we will. But if it doesn't, we won't. I mean, it's, again, the uniqueness of the model. We're not fighting that high decline rate, and therefore you have to drill. Otherwise, you're going to have a huge production drop. We're very fortunate that the model that we've built right now the gas prices are for the remainder of the year are kind of in around that $2 level. Our break even is around $1.85 right now, AECO and MCF. We put some hedges in place. We're paying down our debt over the year as well, and we're still paying a dividend. We're still paying about 6 cents a share, which is over right now with the current stock price. That's over 6% dividend yield. So it's you're getting paid to wait for what we think is a pretty exciting time in the natural gas space coming up, and I think that's one of the big reasons why shareholders are attracted to Pine Cliff is we give them that exposure to natural gas. And we've got, especially to AECO, which is, again, the Western Canadian gas. And there's several reasons why that's a pretty good place to be, and we'll talk about that. But you can see that in the last 10 years of our existence, in 2019, 2020, we had some of the lowest gas prices in Western Canada in 30 years, and we still made money. Not a lot of money, but we still were positive cash flow. Then in 2021, we had the best year in our 10-year history. But then 22 happened. I think 22 gives you a glimpse of what we think could be coming in 25 and 26 and 27 when gas prices we think are going to strengthen for a variety of reasons. We had strong gas prices in 22. We went from $50 million of debt to $50 million of cash flow. That's we did $163 million of cash flow that year. Last year, was an okay year. It was pretty much tied with our second best year ever in our 12-year history. We're entering into our 13th year, as I mentioned. I think 24 is going to be look a lot like 23. It's going to be volatile for both gas and liquid pricing, but we're probably the most excited about what's coming after 24. And that's kind of what we've built this model for. And I think that, we put in some slides here. I think what's really important, from my perspective, when we're buying assets, the number one thing I look for is free cash flow, and not just cash flow, free cash flow. So tell me what the company's going to, after they've spent all of their money on capex, on maintenance, on betterment reclamation, how much extra cash flow do they have then to give back to shareholders? And so we look at assets that way. We've always been an acquirer of assets. We've been buying assets for over 12 years now. And for us, again, it's all about free cash flow. If an asset's got $10 million of cash flow, but they have to spend $10 million every year to generate that cash flow, well, then to me, it's not generating any positive income that I can give back to my shareholders, and therefore has very little value to us. Whereas an asset that's generating strong free cash flow, that's important. And that was what's driven the last couple acquisitions we've done. The last two deals we've done, we haven't used any equity at all. So we haven't issued any equity since 2019. And again, that's driven a lot by the fact that we are very, very good stewards, I believe, of our share capital, because we're also big shareholders. And so we're very, very sensitive to dilution. What this slide just shows us some sensitivities. With right now, the forward strip price for this winter alone is over $3 an MCF. So you can see at those levels, we're starting to generate double-digit free cash flow type of yield, and the discretionary income that we have over and above our capex and our dividend gets to be pretty significant. As you can see at $350, between $3 and $350, you're kind of moving to over 25 and almost up to $40 million extra cash flow after the dividend, after the capex. So that's where we'll have capital to allocate. We think there's a few things we can do with that. Obviously, paying down the debt will be important part of that. There'll be potential acquisitions that we'll look at, and there's always a potential for us to raise our dividend again, as we have in the past. This is kind of just showing the hedging. We've protected Q2 and Q3 the most for both oil and liquids, and for natural gas. The reason for that is that the summer months can be the most volatile in Western Canada for natural gas prices, and so that's where we wanted to put the most protection. We have a little bit of protection going out into 2025, but it's fairly not nearly the same levels. And the reason for that is because we really believe that 2025 prices could be a lot stronger than 2024. This is the slide that really shows the differentiation, and I mentioned this earlier for Canadian public E&P companies. You can see that our decline rate is in single digits, and we're the only ones that are in that. And you can see where the gas names in the light blue are. The average there is over 30%. So it really does set us apart. And from what that means is we just don't have to spend much of our cash flow on capex. And so we have one of the lowest percentages that exists in the industry. And that's really important, because if we're not having to spend money on capex to maintain our production, that means we can give it back to shareholders, which is why we like to maintain a fairly high payout ratio. We've been one of the fastest growing companies. We're not thought of that way because you typically think of growth in our industry as through the drill bit, but for us, it's been through acquisitions. And I think I'd like to think that if you can, that we're very good acquirers. Go back and look at every one of our deals we've ever done. They've been highly accretive on a per share basis. That's the key. It's all about per share. I'm not interested in growth for the sake of growth. It has to make sense on a per share basis. And again, that's driven by the fact that management owns a lot of stock. So one of the things I'll touch on here as we kind of wrap up on the presentation is kind of why are we so optimistic about natural gas? And I think there's a variety of reasons. In North America, what we're seeing is a tremendous amount of growth coming from LNG starting at the end of this year, 2024. And it's been paused. In 2016, the United States didn't export any natural gas. It had no export facilities. Matter of fact, it was looking at import LNG facilities. And then it went on a very impressive growth rate of LNG exports, to the point that it became the largest exporter of LNG in the world within 7 years. But today exports around 14 BCF a day of exports. What we're going to show you a couple of graphs here, they're going to more than double that in the next 4 years. And that's a big number because the total production in the United States is around 100 BCF a day of production. So when you start having that much new exports, think of exports as demand. And so when you increase the demand for the product that much, it's going to have an impact on the commodity prices. And I think that's a key part. The other thing that's so unique and why Western Canada is going to be, we think, one of the many reasons why Western Canada is a good place to be a natural gas producer is that we're finally getting our first LNG export facility in Canada that's going to start being commissioned here this year. Matter of fact, the Petronas CEO just came out a couple of days ago and said that he expects to see the very first LNG ship leave the Kitimat Harbor, which is in northern BC, in 2024, which is ahead of expectations. Most people are kind of thinking it's going to happen in 25, so we'll see. But in any event, the point is it is right on top of us. And LNG, the global demand for LNG continues to rise. We got Shell and BP and others that are come out with projections that we're going to see LNG demand rise by 50% more by 2040. So it's an exciting market to have access to. I think on the local basis, one of the things that we're quite interested in, the fact that Alberta natural gas demand, as you can see, and in the US was setting records in the first quarter, even with these low prices. So, we've had one of the warmest winters in history for the Northern Hemisphere was had this last winter. Despite that, we're seeing demand for natural gas was very high. So I think what that's setting up for is a very, very strong structural market for natural gas. This is the graph that I was pointing out to. This is where we are right now, just at the end of 2023 at 14 BCF a day. But you can see that quickly within 4 years that North America goes over 28 BCF a day and then continues to rise. And this there was a moratorium discussed in the US, and that really is on potential projects after all of these projects. So the moratorium that President Biden had suggested might be put in place does not impact at all any of the current LNG projects. So as you can see, the United States continues to hit record numbers on LNG exports. And now, like I said, Canada is going to join that. And what's so critical to that is that Canada is only 10 days shipping to the number one LNG import markets in the world. The top 4 importers of LNG in the world are China, Japan, Korea, and Taiwan. And the advantage of only having to send 10 days out of Kitimat, BC is really critical considering the Gulf of Mexico takes 24 days. So a huge advantage, not just economically, but from an emissions standpoint, because economics are saved because you've got ships on the water a lot less time, and you typically rent those ships by the daily rate, but also the amount of emissions you're going to use. This is quite striking, and this is LNG Canada, the pipeline that was built, a brand new pipeline that was built right from Alberta going all the way over to Kitimat, BC. That pipeline is now 100% complete. So LNG Canada, the actual site, is a $40 billion project. It's over 90% complete. So again, we're looking at that plant being commissioned this year. There's other LNG facilities that are being built off the west coast of British Columbia, smaller. But the other thing that's really important to know is that LNG Canada is 2 BCF a day of exports. Phase 1 is 2 BCF a day of exports. All of production in Canada is only 18 BCF a day. So over 10% of all of the production in Canada will start to be exported this year or early next year. And then the next phase of LNG Canada will be another 2 BCF a day. And they haven't yet gone positive FID, which is final investment decision, but that's expected to happen because the pipeline they built has capacity for 5 BCF a day. So they don't have to build another pipeline to the Kitimat area to increase the production by more than 2.5 or by another 2 times. So going to over 4 BCF a day. So that's very exciting. I think that the other thing I would point out, we've got the LNG projection slide here, but another real key piece is Alberta. Alberta alone is increasing its natural gas demand by half a BCF a day this year. Again, remember, we only make 18 BCF a day, so that's a big number. That is all industrial demand. That's the coal to gas shifting. That's some of the new plants, the power station plants that are being put in place that are natural gas fed. The other thing to keep in mind, and why Alberta is such a strong place to be for a producer, is that the biggest user of natural gas in all of North America is in Alberta, and that's the oil sands. So the oil sands ship oil by it's a heavy bitumen that they pull out of the ground of what they call SAGD operations, which is steam assisted gravity drainage. And what they do is they use the natural gas to heat water, to create steam, to put it in the ground, and that allows the bitumen to flow. And the TMX pipeline is now about to be opened in the next month or two, which is going to expand Alberta's ability to send oil to the West Coast from 300,000 barrels a day to 900,000 barrels a day. And so that means more natural gas will be used in that expansion projects. So on a short-term basis, right now, natural gas prices are depressed because we had this unbelievably record warm winter, and therefore storage has become quite full. But when you look forward, things look pretty positive. I think the industry spends a lot less money. It used to, one thing if you're not a long-term energy investor, you may remember the days not that long ago when our industry spent more money than brought in, and did that for decades. And they did that by drilling and continuing to put money into the ground. I think what's very key is that in the last 5 years, we've seen a real shift. And now the industry is now giving money back to its shareholders. And so therefore it's spending a substantially less amount than what its cash flow is. That is a change in the industry, and I think it is really going to be something that investors are going to take note of. So I mentioned that storage is higher than normal because of the really warm winter. What I would point out, though, is that storage hasn't grown at all in North America over the last 10 years, but supply and demand has really grown. So we've got, it's almost doubled the size. I mentioned Canada and the United States together about 118 BCF a day. That it used to be like 50 to 60 BCF a day not many years ago. So what that means is that as supply and demand continue to battle because of weather, for instance, all of a sudden then you have more supply than demand because demand dropped and supply continued. That's going to fill up storage very quickly because storage is the same size of tank, even though you've got much larger forces at play. But that goes the other way too. And we saw this. We saw this in fall of 2022 when gas prices were over $10. So, and that's when demand quickly accelerated past the supply point. I think that's the kind of market we're heading into, because of the LNG Canada, because of LNG out of the United States, because of LNG out of Mexico, which will also be drawing down on US and Canadian. And I think from those, there's a lot of talk about energy transition, and for very good reasons. I mean, that you look at that, the exponential growth that you've seen from renewables, from wind and solar and from geothermal. But the reality is that in 20 years ago, 86% of all of the energy in the world came from hydrocarbons. And today, 20 years later, 82% comes from hydrocarbons. Yes, it's been huge growth, but it's still a very small proportion. And the biggest growth of all the hydrocarbons around the world has been natural gas. LNG growth has been just extremely impressive. Coal actually had its best year ever last year. And then oil, it continues to grow, between 1 and 2 million barrels a day of growth going forward. But natural gas, everywhere natural gas is used, it's continuing to move up. And it's because LNG is much more available. And I think that's the key, is that the LNG growth has really changed the dynamics for natural gas. It is becoming very much a global commodity, where it used to be very provincial pricing. Now it's a global price. And as you can see, Shell's calling that we're going to have a shortage of LNG export facilities in 2027, even with all that growth that I just pointed out that's coming. So that's a very fast summary of Pine Cliff. Hopefully that was some use. The presentation's available on our website, as is many of the speaking conferences and investor relations activities that we've done. You can hear at our website. And I would highly encourage you to sign up for our quarterly email that we send out that also talks about the macro of natural gas.
Could you tell us about yourself and walk us through your career?
Yes, it's been I've been around oil and gas all my life. My father was involved in the oil and gas industry, hauling salt water from the well sites. So I used to go out as a kid to help him. I don't know how much help I was, but so that I've been doing all along. I was originally I entered the sector as a lawyer, so I was a partner at a large law firm here in Calgary, Alberta. But I did a lot of oil and gas transactions, M&A transactions, securities transactions, commercial deals in natural gas and oil. And then from there, I joined a client that had a natural gas technology company, a global natural gas technology company out of Vancouver, BC. And so I traveled a lot. They converted diesel engines to natural gas engines. So I traveled all over the world, a lot of time in China, but a lot of time in Europe as well, with putting joint ventures in place with Volvo, with Isuzu, with Ford, with Cummins, with Weichai. So I did that for 5 years. I came back to Calgary and joined an investment banking firm. So I did investment banking for a period of time. One of the large transactions I helped organize was a $1.2 billion investment by a Chinese entity into a Canadian oil and gas company, a trust at the time. And so after we did that transaction, they asked me to come over and be a senior executive with them and run their business development program. And so I did that for about a year. And during that time, I was approached by a gentleman by the name of George Fink. And George Fink, I had got to know through my previous relationships as both a lawyer and investment banker. George Fink was one of the best stewards of capital that existed in the oil and gas industry. George ran a company called Bonterra that had paid over $1 billion in dividends over a couple of decades. And so he approached me about the idea of starting up a new company that would be natural gas focused, that would eventually be a dividend payer. And that attracted me very much, because that was something that I really believed that would be well received by the market and something I personally wanted to invest in. And so that was January of 2012. And so I'm now going into my 13th year as the CEO of Pine Cliff. I was the employee number one back when we started up Pine Cliff, and we had 100 barrels a day of production.
Thank you. So, in your career, what would you consider to be your greatest achievements?
Yeah, I like to think my family would be right up there. So if you put that aside on just focusing on the career, I think it's on building Pine Cliff from just being me to a real thriving, $400 million enterprise. We went from 100 barrels a day to 25,000 barrels a day through acquisition. We've got an excellent team here that has really been supportive from the beginning. We got some people that have been with me now going on 10 years. And so that's we're very proud of what we've built, because it hasn't been easy. The oil and gas industry is such a volatile, because of the commodity prices. You don't control the commodity prices. It's not like when you're making widgets. For us, we have to be able to roll with those punches. And I think we've done a very good job. I think we've set ourselves up as very good capital allocators. I think even though we've grown quite rapidly, we've done it very selectively. And so there's been a couple times where we've gone 2 years. This last deal we did in December of 23, it had been 2 years since we had done a previous deal. It wasn't that we weren't looking at deals. It wasn't that we weren't negotiating and weren't putting in offers. It's just we refused to to give up our discipline. And that's, I think, driven by the fact that the model and the fact that we are such big shareholders as well.
And regarding shareholding, how large is your own equity stake in Pine Cliff?
With myself, my wife, and my 3 children, we'd be over 12 million shares. I'm over 10 million shares myself. And so that's our wealth. We're all in. I've never sold a share of Pine Cliff, and I bought more last week, and I'll be buying more here coming up, because I really believe in what we've built. I really think that we're going into a period of time where there's going to be some the potential for some appreciation in our stock price. And those who I think I've built up some credibility. I've been, in the sense that we've been doing this for 12 years. I don't say that all the time. I mean, if you went back and listened to presentations, I really have always believed in the macro of natural gas. I've always believed that natural gas is going to need to spend more time over $3 than under $3, because just to be able to motivate the industry to produce the natural gas. But there's been times when I haven't been as bullish as I am right now. I don't know if I've been much more bullish than I am looking into what's going to happen here on the infrastructure side, on the LNG side, on the natural gas increase in demand that's going to happen in Western Canada. It's tough not to be bullish looking at the forecasts.
Thank you. So then, how have you built the management team and board at Pine Cliff?
Yeah, I mean, it's been slow. We've been very selective. We liked it. I know new people coming into our company have commented on that sometimes they think too long to make our decisions, but that's been the model. The model's been slow to hire. And where we've made mistakes, we've tried to rectify them. And luckily, we haven't had to make many of those changes over time. We've had very little turnover of people leaving. We've got some really long-term employees that have been here as we've grown. Like I said, we now are about a little over 100 employees, another 50 contractors on staff. We've always run fairly lean in the head office, but everybody's an owner. That was one of the philosophies. We're one of the few companies, I think, that gives stock options to everybody in our entire company. And that includes the field staff, and includes all of the clerical staff, all the people in the head office. So I think, in our board, I would argue that our board is, when you look at the credentials of the people on our board, it is a board that you would expect would be responsible for a much bigger organization than Pine Cliff. We've got some tremendous experience on the people we put on the board of directors. And again, very selective, very patient. We waited for some of these people to become available. We've been talking to them for a long time. So I'm very proud of the team that we've put together, both at the management level and also at the board level.
Thank you for being here today, Chris. So could you tell us about yourself and your career?
Yeah, thanks, Jasper. So I started my career articling at the global accounting firm Deloitte & Touche, and worked in various roles there. Initially, I started in audit and tax, and later on, I worked in the valuation group and worked on transaction services, which included things like due diligence and corporate finance initiatives. While I was there, I completed both my CPA and my CFA designations, and then immediately jumped into the investment community, where I spent 20 years in the capital markets. While I was there, I spent 13 years as a publishing analyst covering the oil and gas space. And then the last 4, I was running the energy side of the investment bank for a large private Canadian bank. And then come September 2023, I started at Pine Cliff.
So thank you, Sarah, for being here. Could you tell us about yourself and your career?
Thank you very much for having me today. I appreciate the opportunity to talk about myself and Pine Cliff. My name is Terry McNeill. I'm the Chief Operating Officer of Pine Cliff. I've been with Pine Cliff for almost 10 years. It'll be 10 years this April. It's amazing how time does fly, and I can't believe how exciting of a ride it's been. So I'm a professional engineer with over 30 years of experience in oil and gas, and predominantly in Western Canada, although I do have some international experience. I consider myself a bit of a generalist oil and gas engineer. I know a little bit about a lot of different things, but my specialties really are production operations and negotiations, contract and agreements. I've got quite a bit of experiences in those that I draw on. At Pine Cliff, I am responsible really for all things non-accounting. So, what does that really mean? It's field operations, production, exploitation and development. I've got a group of surface and mineral land folks that work for me, commercial negotiations. So it's a very, very challenging role, but I'm very, very lucky to have an excellent team here to support me. And, every day is exciting and every day is a new experience. So I love my time at Pinecliff, and it's been great.
Could you summarize Pinecliff's capital structures?
Sure. So our capital structure is fairly straightforward. We currently have 356 million shares outstanding, roughly. There's another 20.7 million stock options, or about 5.8% of that 356 million outstanding, which would take us to a fully diluted number. Insiders own about 14% of the shares outstanding, or around 16.5% on a fully diluted basis. And I think it's also worth noting that our top four shareholders account for about 30% of the total stock outstanding, which creates a strong base for our shareholders.
Excellent, thank you. By the way, who are your largest shareholders? But besides AECO, who are the other large shareholders?
Yeah, there's some private individuals who are, and then management as well, account for the lion's share of that 30%.
Could you summarize Pinecliff's financial position? How much cash do you have? What's the working capital, debt, interest rate on it too, and also the amortization schedule?
Yeah, again, I think we keep a fairly simple cap structure throughout our balance sheet. We have a small $8 million operating line with a Schedule 1 bank. That helps manage our month-to-month cash flow. So we currently pay about 9.2% interest on that facility today. We also have a $56 million term facility with a private investor, and that was used to fund a portion of the Certus acquisition that was closed in mid-December. So if you go back to prior to that acquisition, we actually had about $50 million of cash on our books. So the cash and the term facility together is what we use to fund the acquisition with no equity. That particular facility has an interest rate of prime plus 3.65%, which today is around 10.8%. Which we believe today is very competitive for this type of facility in the current market.
Excellent. And how much of that term loan will you be looking to repay in this year?
Yeah, so in 2024, the term facility itself has a fixed amortization of 15% a year. So that works out to about $8.4 million in 2024, payable $2.1 million per quarter. However, at current strip, we expect to generate about $60 million of cash flow, or about $9 million of incremental free cash flow. So assuming that the strip holds, we'll consider whether additional debt payments are prudent, or if there's another more advantageous allocation of that incremental free cash flow to shareholders.
Thank you. And then, so what leverage ratios are you comfortable with? And measure that as net debt to EBITDA.
Yeah, so we've always said that in a normalized gas price environment, we would be most comfortable with a debt to cash flow ratio of around 1 times. And we're down at around 1 times today in what we would consider to be a very weak gas price environment. So we feel very comfortable with our balance sheet position today.
Well, say that another acquisition opportunity turns up that looks very attractive. How much do you think you would sort of like to stretch on a net debt to cash flow basis on that multiple?
Yeah, I think if we looked at other acquisition opportunities, of course, I mean, when you look at our history, we typically don't buy pure exploration opportunities. We're more of a development company. So that would probably come with cash flow, probably come with some sort of inventory of opportunities. So again, there would probably be some additional leverage room that may come with another opportunity, with some additional assets. But we're always going to look to be very prudent and consider what our funding options would be should another acquisition come our way.
Pinecliff has an operating model that differs from quite a lot of other E&Ps. You focus on low decline legacy assets, and you grow through acquisitions rather than through the drill bits. So, but could you still explain Pinecliff's model?
Yeah, I think you summarized it very well just there. It is a very unique. There's really no other public company in Canada that's got this model, and there used to be the trust model that existed in Canada, and what it was were vehicles that were really built to try to return as much free cash flow back to the shareholders as possible. And there was tax changes that eliminated that structure, but I don't think the demand for that type of product ever went away. I think investors, for us, we're like a long call on natural gas in Western Canada without an expiry. And so you've got good exposure to natural gas, which if you go through our presentation, you can see why we believe that that's going to is an exposure that's going to be very helpful. But at the same time, we've got a very flexible structure. So we've got the ability to, this year, for instance, we have a CapEx budget in place for the back half of the year. If it doesn't make sense to drill in the back half of 2024, we won't drill. If it does make sense, we may increase it. I mean, I think what we've become to our shareholders is very good allocators of capital. If it makes sense for us to do a transaction to buy more assets, then we'll look at that. If not, that will pay down the debt. I mean, we could be on forward strip. It's possible that we could be debt free by the end of 25, depending on what happens with commodity prices, and that's fine. But if there's an opportunity along the way that we think is a better use of our capital, we'll do that. And the dividend, like I said, we're not scared to adjust it. In my mind, it's a variable dividend that is trying to constantly be adjusted to whatever's going on in the market, but always with the goal of trying to give back as much free cash flow back to the shareholders as possible. High payout ratio. And again, we can do that when you don't have to spend a lot of money on the drilling. So that's why the low decline really is the secret ingredient to this model, is that you want to have that low decline, because then that gives you maximum flexibility as to how to allocate the capital. And I think that's our job. Our job is to allocate the capital in the best way possible. So that if that means increasing our CapEx drilling, that could, if it means, or decreasing it. And I think we've shown the ability and willingness to do both. So we're not married to any specific other than the protection of the long-term dividend sustainability. That's the goal. And that's why we adjusted it going into this year. We reduced it a bit because we really don't want to be in a position where we didn't want to use any debt to keep the dividend going. I don't think that's sustainable. And so we'll focus on paying down the debt, and then hopefully focus on increasing the dividend over time.
You acquired Certus Oil and Gas, and you were it was one of the very few deals that actually closed last year. So at least all this in the smaller and on the junior side. So could you explain the rationale for the acquisition of Certus Oil and Gas?
Yeah, for us that was it really was something we've been watching for a long time. So the Certus assets, we had actually looked at more, I think 2 or 3 times over the last 5-6 years when they were with different owners. And so we knew the assets very, very well. And the opportunity we were waiting for was for them they were going to sell off some of the assets that we weren't interested in taking, which were heavier oil and higher liabilities. And they did that. And then that's when we became very interested. What the key for us was, we've been trying to get into, the area that had multi-zones potential for drilling, and that what we call west of 5, which is the area we own some assets in that area, but we're looking for more, and we want it to be a fairly substantial core position. And so ideally it would be over 5,000 BOE a day, which this one was. We're quite excited that it had some liquids, oil and natural gas liquids, because that helps with the sustainability of our dividend. We didn't want to be only subject to natural gas prices, even though we are heavily weighted to natural gas. We were quite comfortable with adding some oil and natural gas liquid locations. We've seen the drilling results in this area, and they've been very impressive. So that was important. And, that inventory was key. We've done very well in our Twining area, which is in the neighbor Ghost Pine area, very close to these assets. But we wanted to add some more drilling inventory. That was a important part of it. And so we think there's a lot of potential in this area. From reserves, what we've looked at, it's a new core area. And I think it makes our dividend even more sustainable going forward because it has some oil and natural gas liquids attached to it.
So how has the integration of Certus assets gone so far?
So far, it's gone good. I'm not going to say it was entirely easy. Anytime you bring in it was a corporate transaction. And so they had a lot of processes in place that were different than ours. And so we had to modify them and get them on the same software and the same accounting and the same land processes that we run here at Pinecliff. So there's always I'd give full credit to our team because they did a tremendous job from on the accounting, on the joint venture, on the land side to integrate those. And now the operations now have really dug in, and they're seeing some opportunities here that we think there was some low hanging fruit that maybe was not attended to by the previous owners. And so we think we can hopefully take advantage of that and maybe lower some costs from an efficiency standpoint. So, they're never easy. This was, we were 20,000 BOE a day before. This was a significant transaction for us. I mean, this was 20% increase in our production, over 20% actually. And so this was a fairly big deal. This was, one of the second biggest deal that we've ever done in the history of Pine Cliff. So it was, but I think we're through the worst part. I think we're clearly now, a lot of the processes have been adopted, and it's been well integrated in.
Pinecliff quite recently released, the reserve update, or the 2023 reserves. And could you give an overview of Pinecliff's reserves? Oil and gas, NGL split. What's the quality of your oil? You also have some Coalbed Methane. If you could add to that.
You bet. We so on March 4th we released our annual 2003 independent reserve evaluation. It is available on our website, so all the critical information that anybody would want is all there and available. But from a high, and the year-end reserve evaluation, we did complete our Certus acquisition in middle of December of 2023, but we were able to put a combined Certus and Pinecliff report together and publish it. So that's really what we have. The results, we had a 1P booking of 62 million BOEs, which works out to be about 280 million on an MPV 10 basis. And from a 2P basis, we were just a shade under 90 million BOEs, which is roughly 470 million on an MPV basis. So those valuations are inclusive of all asset retirement obligations. So any of our abandonment obligations and reclamation obligations, and all of our closure obligations are all included in those numbers and in those bookings, timed appropriately. The split from a production or a perspective, it's about 7. It really depends on the classification and the category, but generally speaking, we're about 75 to 80% natural gas, about 10% oil, and then the remainder will be NGLs. So the oil itself, we produce a very high quality premium crude in Western Canada by Western Canada standards. So we do get a very healthy price on our crude oil. And then the NGLs will be a mixture of ethane, propane, butane, and condensate, and really depend on the delivery point. So that's roughly the split, and that's the amount that we have.
By the way, the Coalbed Methane, is that a separate part?
Good question. So the CBM, or the Coalbed Methane, just rolls up into our conventional. We do have it forecasted out separately, but the Coalbed Methane just rolls up with our natural gas. It's got no liquid content to it. It's all just methane, and it rolls up into our gas numbers. So, we do have separate reserve bookings for each category, each area geographically, including the Coalbed Methane plays, but they just all roll up to our natural gas, overall aggregate natural gas number.
What is your reserve life index, 1P and 2P?
So our 1P reserve life index is just a shade under 7 years, and our 2P reserve life index is just, I think it's 9.7 years right now. So, one of the challenges we always have at Pinecliff when it comes to RLIs is our shallow gas assets are difficult for reserve evaluators to properly assess. And, what makes them difficult is they have got, typical annual declines of very, very low, 2 to 4%. But the productivity per well is also very, very low. So they produce at a low rate for a very, very long period of time. And so at times it's a little bit difficult on an RLI basis, but even at a 10-year RLI, it's relatively decent. The Certus acquisition was a big piece of trying to make sure that we add a little bit. We don't really track the RLI on a regular basis, but it did. The Certus acquisition did allow us to extend it out just a little bit more.
Thank you. And then, so what AECO prices are you assuming in your reserve calculation, or are the reserve evaluator really assuming?
You bet. So, as part of the independent reserve evaluation that we do, as with most Western Canadian producers, we use the average price deck of the 3 major independent reserve evaluators, and that's what we had used for ours. So the actual pricing itself from an AECO perspective is about $3.30 Canadian per MMBTU for the next 3 years. I mean, as you well know, it'll vary from year to year. And so I just tried to use a sort of a 3-year average is about $3.30 Canadian per MMBTU. So right now, AECO pricing, as you folks are well aware, it's been a very, very warm winter in Europe. It's been a very, very warm winter in North America, and gas prices are a little bit less than that. But when you look at the current forward strip in North America, particularly when it comes to AECO, the next three, starting in 2025 and extending forward, the average forward strip price is $3.35 per Canadian per MMBTU. That's the lowest, and it climbs up from there. So, the 330 that they've used for the forward 3 years, although it's a little bit aggressive for where we're at today, really feels like it's right on the mark for where we're headed to. So it's it's an exciting time to be a natural gas producer, as I'm sure you and many of your listeners are well aware. I'm sure Phil probably got into a lot of the macro aspects of it. So anyhow, that's the pricing that we used on an oil basis. It's about $75 WTI for the next 3 years is roughly what we used. So, I think they're pretty fair pricing.
Thank you. And then, so could you walk us through Pine Cliff's core areas and associated production from them?
Sure. So about 85% of our production is from the province of Alberta, with about 15% from the province of Saskatchewan. So we're very, very Alberta focused. Our assets themselves are, what we characterize as mature legacy assets. That means that they've been on production for a number of years, and a lot of them have already been had quite a bit of development to them. So the downside, the downside is you miss a lot of the initial flush production that you get when you bring some new production on. The advantage of it is you don't have to pay for a lot of that capital. There's execution risk, there's geological risk, and there's capital required to develop these plays. That's all been taken care of when we get them. So we get them as legacy assets. Typically they're producing assets that are part of a much larger formation and pool. So they're going to produce for a very, very long time at a very, very low decline rate. So, that's really what a lot of our portfolio is. And that's what allows us to have a sub 10% corporate decline. We claim, and I do believe it's factual, that we are the lowest per annual production decline of any publicly traded oil and gas company in Western Canada. And a lot of it has to do with the legacy assets that we do have. Our main, and then I guess the other advantage of a low decline, and I'm sure Phil would have explained it, is the low sustaining capital that we have to maintain our production. So, it allows us to be patient, allocate capital accordingly. When commodity prices are stronger, we'll probably be a little bit more aggressive and with activity. And when they're lower, we'll be probably a little bit more less aggressive, but it allows us to maintain our production. So that's really the gist of a lot of our assets themselves. Our main areas, and what I would say our core areas, really in the Edmonton to Calgary corridor. We straddle the west of the 5th meridian. So for any of your listeners who are familiar with the province of Alberta, Edmonton is sort of in the central part. We are from Calgary, which is a little bit towards the south. Highway 2 goes right up from Edmonton to Calgary corridor. We're about 3 hours apart. And our core assets really strand that highway. So there's good access to services. The wells on a productivity basis are typically a little bit better. Good liquid production, which is great and helps the economics. So that's really our core area. The Certus acquisition fits right into there. So, again, how do you characterize your assets? We've got a number of different ones, but, a lot of them are legacy assets, but we do have in the Certus assets, plus in the Ghost Pine Twining area, we've got some, exciting development opportunities. And so, that's kind of it in a nutshell, what our assets kind of look like.
Perfect. Thank you. And could you add to the potential of the inventory that you inherited from the Certus Oil acquisition?
Sure. The Certus acquisition was really strategic. It had some really good PDP production, which was great. But, the upside was really, really quite exciting, and it can be characterized in a few different buckets. But, the most immediate upside that we see is in the Glauconitic formation. It's an overpressured formation in the Manville stack. And it's being quite aggressively pursued by a number of different producers. So we saw the opportunity to acquire Certus and get a meaningful position within the Glauconitic formation. So that really is exciting. And we added a number of locations there. But I think on the longer term, the near term development on the Certus properties are going to be in the glauconitic formation, but I think the longer term benefit is in the Ellerslie formation, which is also in the Ellerslie stack, but it's in the Manville stack, but it's less developed than the glauconitic, but it's quite a bit more widespread and regional than the glauconitic. So we really added no value to the Ellerslie in the Certus acquisition, but I think we've got somewhere between 20 to 25 gross locations already identified, unbooked in the Ellerslie that we would like to develop. I would say that's probably a 3 to 5 year play, whereas the Glock is probably the near term, the 1 to 3 year play, if not a little bit more. So, we're really, really excited. It's an exciting area. There's also a variety of other zones that we want to continue to develop. So, the Certus area was really strategic, not only for the overpressured Glock, but the emerging Ellerslie. And then it gives us quite a bit of exposure to many different producing partners and intervals in a new producing area that's really quite active. So it's a really, really exciting area for us.
Excellent, thank you. And by the way, Ellerslie and the Glock area, where are they located? If you look at, for example, a map of where you can see the trend from Calgary to Edmonton, and then you have Edson to the northwest. Where?
So we would be south of Edson. If you looked at Calgary, it's actually surprisingly close to Calgary. It's about an hour to an hour and a half outside of Calgary to the northwest. So towards Edson, but probably about a third of the way from Calgary to Edson. So, it's surprisingly, it's a great producing area. There's lots of access to services. Good infrastructure, good access to infrastructure. Good roads, which is always good. Sometimes when you get back into some certain areas, it can get tough to get in and out of. So, again, it checks a lot of boxes for us.
The overall area is called the Caroline area.
Yeah, you bet. And Caroline, Sundre, they're all kind of rural towns within Alberta. So Rocky Mountain House, Sundre, and Caroline, those are the general areas for any of your listeners that are available. If you look at a map of Alberta, you'll see all those areas. So, the main Certus area, the one that we're most excited about, is just north of Sundre. But that's a good point. The areas, Caroline and Sundre get used somewhat interchangeably.
Thank you. And could you add some color to the well metrics that you have on the Glock and Ellerslie area? Sure.
So I'll start with the Glock. The Glock itself, we want to try to develop these on 2 mile horizontal legs. So, they're about 2,700 meters deep. And then the way well spacing is in Western Canada, it's all based on miles. So we want to be able to drill 2 mile horizontal legs within the glauconitic formation. That's the most capital efficient way that we've seen it. And I think other producers in the area, that's the way that they're developing it as well. So on a 2 mile horizontal Glock, the IPs are sort of in that 1,000 to 1,600 BOE per day basis, about 35 to 40% liquids. A lot of those liquids are going to be high quality condensate, which, fetches a fairly premium price. The internal rate of return, or the IRR, at 10% is using a $3 flat per MMBTU price deck and an $80 WTI is about 145%, and they'll pay out in about 12 months. So very, very good wells. From a MPV basis, you're looking at about $9 to $10 million on an MPV 10 basis. So, the glauconitic is really quite a prize for sure. We're really excited about that. On the Ellerslie side, I think because it is an emerging play, the results have been somewhat variable. So it's difficult to put a specific metrics on it. It's certainly not as prolific as the Glock. It's not overpressured as the Glock is, but there's some really, really good Ellerslie wells. And at this point in time, as with any emerging play, there's probably some that aren't quite as good. So, the goal is, and that's why it's a 3 to 5 year project, is to continue to understand the play, understand the geology, understand the engineering, and make sure that, when we want to go and put a bit in the ground and drill our first Ellerslie well, that we're confident in the results. So it's not going to be as good as the Glock, but it is going to be very, very good nonetheless.
What improvements or room for improvements do you see?
One of the exciting things, and we've already done it when we looked at the Certus package, particularly in the Caroline Sundre area where the Glock was the most prevalent formation, one of the challenges that we saw when we did the acquisition was it was very spread out and checkerboarded. So, it's difficult to control the pace of development when you don't have an established land base. And that was one of the problems that we had seen with the land base when we bought it. So, in the 3 months that we've owned it, we've already been able to work with some of the other area producers, and one major one in particular. And we've done a bit of a land swap of undeveloped acreage, which has allowed us to increase our land holdings to key sections around our owned and operated infrastructure. So I think that's really one of the opportunities that we saw as part of the acquisition. And we've already delivered on that, which is fantastic. So it's allowed us to increase our owned and operated 2-mile block inventories, which is critical for us. And it's so we can control the pace of development and tie it into our own operated infrastructure to be able to operate it at lower price and have good access to infrastructure. So, that was one of the ones that we had seen early on that was a real opportunity. And we'd already had some discussions with some of the area producers ahead of time, just in the event that this were to come to fruition. And we're going to continue to do that. There is exposure to a new set of partners. Not everybody wants to be in that area. So, again, from an A&D, is acquisitions and divestitures are a big part of our business. So that is another area to build from. And I think the other one, I think this is our 14th major acquisition that we've done since I've been here at Pine Cliff. And in each one, we don't really factor into the acquisition metrics of the model, but we've always been able to reduce operating expenses, through a little bit more efficient operation, and providing a little bit more accountability at the field level to the staff. And we've always been able to try to add some value to the properties that way. So I think on the near term, that's the other opportunity that we see, is being able to add a little bit more responsibility, accountability to the existing folks, and hopefully overall being able to reduce operating expenses as well.
You will have a quite modest capex budget for this year, 17.5 million Canadian. How will you spend that capex?
Sure. So good question. I know when it comes to capital and capital discipline, that is one thing. Low decline production allows us to be very disciplined on our capital side. So coming into the, we had just completed the Certus acquisition in December. It's a busy time. I think one of the biggest things that we wanted to do, low gas price, busy time, complex asset. We need to make sure we take the time to understand the asset itself. So to jump into an aggressive capital program on year one probably just didn't feel like it was the right decision. We need to understand it. Plus, it's no secret AECO prices have really fallen off as well. So it just didn't feel like that was the right thing to do. So after a lot of debate amongst the management team, we decided to limit the capital budget to $17.5 million. About $4.5 million of that is going to be for maintenance. So that's equipment maintenance and integrity, pipeline integrity, to make sure that our equipment is in as good a shape as it can be to produce or to operate for a long period of time safely. So that's really what $4.5 million will do. So that's equipment maintenance, overhaul, inspection, pipeline integrity, that kind of work. We've got $7 million budgeted right now for asset retirement and closure obligations. So as with any big producer, we do have a lot of wells, and so we do have to make sure that we're a responsible producer that looks after our end of life obligation. And that's really what that $7 million is. So well abandonments, well reclamation, remediation, and environmental cleanup work. That's what that $7 million is targeted for. And that leaves about $6 million of what we call discretionary spend. So that discretionary spend really has no production uplift or reserve uplift associated with it right now. And it's going to be for optimization. It's going to be for emission reduction, compliance projects. It's going to be for land addition. It's kind of, it's not been allocated out, but it's really, we need a certain amount of capital to continue to run the business and make sure the business is set up for future success. And that's really what 2024 is for us, is to integrate the Certus assets into our portfolio, make sure we've got our drilling inventory stacked appropriately, make sure that we've got locations drill ready coming out of 2024 and into 2025. And so again, a modest capital budget for 2024, that really allows us to do that. So that's the split, and that's the rationale behind it. So hopefully that makes sense.
Your best asset has traditionally been the Pequiscoat winning, especially your North Twinning unit. We have your tier 1 wells. Could you have some color on the well metrics, and also how many booked and unbooked drilling locations you have at the North Twinning unit?
With regards to the North Twining unit, I mean, we just kind of roll our unit and non-unit wells together. We just call them Twining Unit 1s. And we've got about 20 book locations gross, which is about 18 net locations remaining. We're really, really excited about the Pekisko play. We've got 6 locations right now drill ready. So if we wanted to drill, we could go and drill them right now. We just didn't feel it was the right time given the Certus acquisition and the gas price where it's at, as I'd explained. So the metrics themselves are, the capital costs are sort of in that $3.5 million range. The rate of return is similar to the Glock, but probably not quite as good at the same gas and oil price. The rate of return, it's probably going to be in that 110% to 130%, depending on commodity prices or commodity assumptions. The payback is probably going to be just a shade over a year, probably closer to a year and a half. It really depends on the location where it's at and that kind of stuff. So, we're really excited. It's got a different gas oil split. I mean, whereas the Glock is in that sort of 35 to 40% liquids and 60 to 65% gas, the Pekisko is probably closer to 50-50. So a little bit more oil weighted. And it's a great play. So we've got 20 gross booked, 18 net, and we've got 10 unbooked locations and 7 net unbooked locations as well. So we've got a healthy inventory. The IP isn't quite the same as what a Glock is. It's probably about a third or a quarter of the IP as a Glock. But again, the capital is quite a bit less. So, you're going to have to drill quite a bit more Pekiskos to match one Glock, which we have to take into consideration. So again, we're really, really excited about the play. It's certainly not deteriorated in any way. It's just allocation of capital, and those will be exciting decisions that we'll get to make later this year and into 2025.
How many wells would you have to drill? And now, of course, it varies. You can answer it, but because the Glock wells have a lot of higher production rates than Pekisko, for instance. But if you would like to add some color to how much you have to drill, or really how much you would have to spend for the production to stay flat?
That's a great question, and I know you're 100% right. It really depends on the well location. Depends on our working interest in the well. I mean, sometimes we're higher than others. The low decline, it's roughly 25,000 BOE a day. We really only have to develop between 2,000 to 2,500 BOE a day to stay flat-ish. So, you kind of keep that in mind, and you, as you had suggested, the typical Glock will come on with an IP between 1,000 to 1,600. So one would suggest, you only have to drill a couple of those per year to stay flat. But, that is IP. I mean, really, to answer your question, I would say it's probably 3 to 6 locations per year, depending on the location and the zone that we're developing. So, and then from a capital perspective, it's probably about $20 million of capital. Give or take a little bit, again, depends on what's going on, whether we develop in the winter. Winter development is quite a bit more expensive than summer development. But that is one thing that we are really excited about our inventory is it is all season access. We would typically develop it in the summer if we could at all, and we can access it year round. So, our capital costs come down. So, I think that's probably a fair number is 3 to 6 wells per year and 20 million of capital, give or take.
20 million of capital, but then you also have maintenance capital, you have ARO, so what would that add up to?
You know what? Notionally for 2025, although obviously we haven't set any budget, we would be looking at 35 to 40 million of capital for 2025, maybe. Is kind of where we would think we would be depending on commodity prices. There's lots of year left, so you never know. Maybe we're busy on the acquisition front again. It's so hard to tell.
We assume then that natural gas prices more often stay above $3 an MCF than below that. What organic growth do you see in the coming years on average?
Good question. So I think on the organic growth side, we've typically grown historically by acquisitions. So that's typically been our vehicle to grow production. So we've never been aggressive drillers. With that in mind, if gas prices were strong, north of $3 and oil remains sort of $75 WTI or higher, I would suggest it'll never be an aggressive number. Probably modest growth, single digit modest growth is probably what I would suggest. For us, it really is about making sure that we've got a healthy dividend in place with that's sustainable. And growth through the drill bit is always a tough one because, you do a lot of growth through the drill bit, then you've got higher decline, and then you've got to have higher capital exposure in subsequent years to maintain production. So, I don't think, for us, I don't think, having an aggressive capital program funding production growth is really anything that we have on the horizon. It'll be modest single-digit growth through a conservative capital program to make sure that we continue to add value and cash flow. So that's really probably the best way to describe it.
And then, so if we move on to your production, you're producing 24 to 25,000 BOE per day. And how will that production vary over the year?
Well, not a lot, to be frank. I mean, which is the benefit of our 9% corporate decline rate, one of the lowest amongst public companies. I think the way I would think about it is, we've dialed back our capital in the current price environment. It doesn't make a lot of sense for us to be drilling a lot of wells and putting a lot of capital back into the ground at current gas prices, which is a luxury that we do have with our low corporate decline rate. We do still have some flexibility in our 2024 budget that could be incremental in the back half of the year, but all else being equal, I would expect a fairly low decline through the balance of the year. But I would expect it would also be fairly consistent. So I would think about it again, like 9% corporate decline. It's that's a fairly low, low hurdle for us to reach over the course of the year.
But so 21% of the production will be liquids. How much of that will be light oil and how much will be natural gas liquids?
Yeah, about 60% of that 21% will be NGLs, natural gas liquids, and the balance will be light oil and condensate. Plus or minus. It's worth noting that of the 21% of that production, that 21% of our production will account for more than 50% of our revenue at current strip, which underscores the benefit of increasing our liquids exposure through the Certus acquisition.
What discounts or quality differential do you get on your oil sales compared to Edmonton Light? Yeah,
it's going to fluctuate, Jasper, from year to year, or from month to month, pardon me. But we assume on an annual basis that we'll realize around 92 to 93% of Edmonton Light. Notably, Edmonton Light differentials relative to WTI have narrowed recently, which in part might be related to the anticipated startup of the Trans Mountain Pipeline expansion in 2024. But that is the assumption that we work with on an annual basis.
And then, so what premium? Because you receive a premium on your natural gas sales. How large is the AECO?
We do. So we probably average around a 6% premium when accounting for small heat value premium and what we're able to do in terms of diversification of delivery points. And that's before our hedging program. So our hedging program is all physical contracts, which means that the impact shows up as part of the price realizations rather than a separate gain or loss on the financial statement. So you would see that as incremental to the 6% that we get on average.
Super. And then, so could you walk us through Pine Cliff's hedge book for the year? And for next year too.
Yeah, absolutely. So with the dividend and the modest amount of debt that we took on to fund the Certus acquisition, we've increased our hedge position to the highest we've probably ever been. Round numbers, we're probably around 30% of our oil volumes in 2024 that are hedged at an average price of around $100 Canadian per barrel, and 30% of our natural gas volumes at around $3 an MCF. So more or less at the market for oil prices, but fortunately for us, well above the market for natural gas, which certainly helps offset the impact of weak summer gas prices. Next year, you'll see those hedges will start to tail off a bit. I think we dropped to around 20% on both commodities in 2025. But we'll continue to evaluate whether we need to add more or what as we roll through the next 6 to 9 months and the market evolves.
Yeah, you receive it's a small income statement still. You receive $4 million in third-party processing income thanks to your gas facilities. Could you add some color to that revenue stream, and also if you see it increase in the coming years?
Yeah, sure. So the other income, as we refer to it in the income statement, is effectively an offset on the cost of the 3 facilities that we own to process other people's volumes. So in actual fact, in 2023, we were around $5.2 million of that from that. And we expect it to be closer to about $6 million in 2024. It may seem like a small number, but when you put that in the context of a $17.5 million capital budget for the year, it's not insignificant.
Definitely not. Okay, but then yeah, how did you acquired Certus? How did your G&A per barrel change, if it all at all changed?
Yeah, so we tend to think about it on a per barrel basis, but also on a gross basis, because as you move up in production, there would be some economies on a per BOE basis. We're guiding to about $1.25 to $1.35 a BOE, which works out to about $11.5 to $12 million, depending on where you think our production is going to work out. It is a little bit higher than where it's been historically, as we did take on some full-time employees as part of the Certus acquisition. Not a lot, but we did bring some people over. But we've also added some resources outside of the Certus acquisition, as we're a larger company now. We were running probably a bit tight coming into the acquisition, so now that we've added another 20 to 25% of our production and the development opportunities that come with it, it necessitated that we needed to add some more resources. So that also helps explain the increase relative to prior years.
And then, so one of the strengths with Pinecliff is that you have a lot of tax tools, almost 400 million Canadian in tax tools, which means that you effectively don't pay income tax. But if AECO averages $3 an MCF, WTI averages $80 per barrel, and we assume a modest capital budget for each year, in what year would you first have to pay corporate income tax again?
Yeah, there's a lot of moving parts when it comes to corporate tax. And fortunately, when we did the Certus acquisition, we were able to increase the tax pools that we have available to the consolidated corporate as a whole. And it is really hard to look too far out, but perhaps if I put it in the context of the current environment, we don't expect to pay any cash tax in 2024. And likely only a small amount in 2025, even with the contango in the gas curve. So with better commodity prices next year, I think we'd only pay a modest amount of cash tax. But again, there can be a lot of moving parts from year to year. So we'll continue to evaluate as commodity prices move around. But I would expect that the tax burden on Pinecliff in the next 2 years to be fairly modest.
In your $17 million capex budget for the year, 7 million of that is ARO. So how do you expect your asset retirement obligation spend to evolve over the coming years?
Yeah, I think it will continue to be somewhat consistent in 2025, in the absence, of course, of any regulatory changes or significant inflationary factors. I think it's worth noting that we have a $265 million retirement obligation on our balance sheet, but most of our wells are active. So we're only about 8 to 9% that are inactive. So the reality is the bulk of the spending in that obligation is way out in the future. And our inactive liability is at the low end of what we would expect relative to peers.
And so, which is probably good for the viewers to know, is that so at a little over $2 per MCF of AECO, and almost $77 per barrel of the WTI, you will be generating about 40 million Canadian of free funds flow, pre-dividend and debt repayments. So for every $0.50 increase per MCF in the AECO price, how much does Pinecliff's free funds flow increase?
I think I'll put it in a bit of a different context for you. We can back into it. So a 10-cent move in AECO would be about a $3.5 to $4 million change in our pre-hedge cash flow. So if you're looking for a 50-cent move, you'd multiply that roughly by 5. But of course, there's going to be some offsets from our hedge book. But since we're already covering our capex, if you think about the $40 million of free funds flow, pre-dividend and debt repayments, whatever is incremental to that is going to be available for dividends and debt repayment, and depending on what we opt to do with that incremental free cash flow. I think at the end of the day, we're going to look at all the opportunities ahead of us, whether that's changes to our drilling program if commodity prices have improved, whether that's additional acquisition opportunities, or whether that's paying down our debt faster than what the amortization schedule would allow us to do. We do have some ability to prepay our debt over the course of the term of the facility. We'll consider all of those options and determine what we believe is in the best interest of shareholders when it comes to that time.
If you could give your insights in the short term and long term, how you're thinking of AECO and also WTI.
Yeah, and WTI is, my own view is that forward strip pricing is probably being too negative on WTI oil prices. I don't see a couple of years from now, I really don't see WTI oil or Brent oil being in the $60 range, which is kind of where the forward strip prices are. I just think there's still too much demand for oil globally, and that's not going away anytime soon. So that's on that part. We are very, like I say, we're about 80% natural gas weighted, and a very high percentage of that is tied to AECO, which is the Alberta gas price. And, in the presentation, I talk about why I'm very strongly bullish on the natural gas in Alberta because of the oil sand use and in the increase, so that the amount of demand for natural gas coming from that sector. Also, we're seeing that the coal to gas shifting occur in 2024, so that increased substantially the amount of natural gas use in Alberta. And then probably the biggest important piece going forward is LNG Canada. And the LNG have the ability, having Canada finally have the ability to send natural gas to Asia and to the global markets, that really is a game changer. We've never had that capability. And you're now going to take more than 10% of all of the production in Canada is going to be exporting starting in the next 12 months. That's really significant. And I think that's going to we've seen this in Australia. When Australia ramped up their LNG exports for the very first time, it drove up domestic prices. And I think because there's a competition for those molecules now that didn't exist before. I think we're going to see the same thing in North America, which I think, it's going to be a healthy thing for our industry, because you're going to have to do that to generate the type of supply to meet these new demand. So I'm quite bullish in the very, in the next 9 to 12 months. I think we're going to see a change in the natural gas landscape here in Canada and Western Canada specifically. And at the same time, this summer it'll be very much still weather related. So if it's, right now there's weather forecasts of being very hot like it was last summer. Well, if that's the case, then you're going to see a lot more natural gas being used. Natural gas in the United States is the single biggest source of electric power. It passed coal in 2016. So when air conditioning machines that go on, that's when you're going to see more natural gas use. So in the short term, it's going to be all about weather. And so just like it was this last winter, that's why gas prices suffered, is because it was such a warm winter. And therefore, the home heating demand dropped significantly. But I think this is going to be a very short-term phenomena.
Thank you. And then, so you mentioned that LNG Canada is about to commission in December, if I recall correctly. Is that right?
Yes, you're right. Everyone's talking about it. It will be commissioned in 2024. There's even some discussion that ships could sail out of Kitimat sooner. That could happen in 2024 as well. We'll see. There's a lot of work with commissioning a $40 billion facility. So they need to fill up the storage tanks. They need to start having gas flow on the pipeline, the Gateway project. But I think that's all going to happen in 24. The big debate now is, will there actually be shipments leaving Kitimat in 2024? The Petronas CEO, Petronas is one of the partners of LNG Canada, has recently said that he expects the first ship to sail in 2024. I hope he's right.
And and how long is the ramp up?
I think they can ramp up fairly quickly to the 1.9 BCF a day, which will be the initial phase one. I think what'll be interesting is at what point do they decide if they go to 2 BCF, an additional 2 BCF a day. So they've got, they'll have the pipeline capacity to do that. They'll need to spend some more money. They'll need to, commission and build the second phase. But it's a lot easier to build a second phase than it is the first phase. So it's more just an expansion of the existing phase. Then there's there's a Salisma, which is a tourmaline-backed, many of the oil producers and gas producers in Western Canada are backing another project, which formerly was known as Rockies LNG, which is another 2 BCF a day. So, and there's a couple smaller projects that are kind of half a BCF a day, the Heisla and the Woodfibre. So you could conceive where you could get up to over 6.5 BCF a day of exports coming from Canada by the end of this decade, which is pretty amazing because, like I said, we only produce 18 BCF a day. So that would be over 30% of all of our production would then be exported off the West Coast.
At the current AECO price, most North American natural gas producers are cutting production and deferring drilling. What price do you think is required to incentivize material production go?
Yeah, I look to the big drillers for that kind of guidance, and there was one of the biggest producers in the United States is EQT, and they've come out and said they need $3.50 to not only give them a return on their, to pay for the cost, but also give them some reasonable return on their investments. And so, we're significantly below that. I mean, right now the prices are under $2 in NYMEX Henry Hub in North America. And that's significant because now you're seeing producers cut production in 2024, which will help solve the problem, right? Because you're gonna then reduce supply. But it's to get to induce more supply. I think you're going to probably need prices to be well into the $3 to really incentivize the industry to go out and spend the money to bring on more production.
Thank you. And then, so what's your view on hedging?
My philosophy on hedging hasn't really changed over the years, but we do now more hedging than we did before. And the reason for that is the dividend. I've always felt that hedging was important to either protect one of three things. It either was to, if you had a lot of debt, then you better use hedging to be, quite often the banks will require you to do it. But the reason is that so that you can protect the payments of principal, so you don't put yourself into an awkward position with the banks. The second would be a capex. If you're drilling a lot and therefore you want to protect that drilling budget, then that's another reason to have significant hedges in place. And the third is the dividend protection, and that's where we fall. We have one of the lowest capex in all of in the industry on a per BOE basis. We have a slide in our deck that talks about that. Our debt is around 1x debt to cash flow, and it's reducing. We're paying down our debt as we speak. So really it's the dividend. So we're about 30% hedged, which is for this summer, which is on the high end for us historically. It's usually kind of between 15 and 25%. But we knew that 2024 was going to be a volatile summer. So that's why we increased our hedge book for this year.
What measures are you taking to reduce costs, operating, capital expenditures, and also G&A costs?
Yeah, I think the capital expenditures we talked about, we've reduced that already for 2024. It's substantially less than last year. Our G&A, we've always been one of the lower G&A on a per BOE basis in our industry. We run fairly lean. We don't have a huge G&A for a company of our size. And I think from our perspective, one of the things that from continuing to reduce operating costs is everybody in our company is either a shareholder and or a stock option holder in Pine Cliff. So we really ask people to act like owners and therefore make decisions as owners. And that means, if it means reducing costs or making the decisions as to how to spend those costs, I think that it drives the right behaviors in our industry right down to the field level. And that's important to us.
Could you give us an update of the current state of the M&A market in Canada?
Yeah, you know what? We've been very active in the M&A market for over 12 years. I'd say right now it's a bit of a lull, a bit of a quiet. We were fortunate to get a deal done here in December of last year. We know there's going to be some more assets coming out, but it's really difficult to do transactions when there's a wild swing in commodity prices. And natural gas prices have dropped considerably in the last few months. We saw a 50% reduction in natural gas prices over just a few months. That's not good for trying to get transactions done because the expectations of the sellers tend to be either tied to where gas prices were or where gas prices are going to be, whereas the buyers are looking at it and going, well, that may be true, but look at what prices are today. So there's a bit of a disconnect. I think we'll probably see that disconnect tighten up here in the back half of this year. So I wouldn't be surprised if the M&A market picks up considerably in the next 6 months.
But you don't think the current low natural gas prices will be last long enough for Pine Cliff to really be able to take advantage of it?
I don't know.
For bargains?
Yeah, I mean, we're ready to transact. People know that we're here. So we are in discussions. We're always in discussions. We're always looking at assets. So you never know. It's possible. There's different motivations. There's quite often there's times where sellers need to sell for some reason. Either because their shareholders want liquidity or because they have a management succession issue, or there's lots of different reasons why companies and assets get sold. So they may want to generate some capital to be able to put into another part of their business that can generate a higher rate of return than the current assets are doing. So we're always in discussions. I'm always hopeful, but we will be disciplined. So we'll, it'll have to make sense on a per share basis, as every other transaction has made sense that way for us.
Excellent. And I mean, as you mentioned in the presentation, your leverage natural gas prices are very substantial. So if natural gas price would go back to $3 an MCF on average, how would your capital allocation priorities look like? You say that there's no stellar acquisition opportunity.
I think shareholders, the feedback I've received from why people own Pine Cliff has been very clear that they believe us to be very good allocators of capital. And one of the reasons is because of the alignment we have, that we own a lot of shares along with them. So we're always, everything we do is trying to improve our cash flow per share, and therefore allow us to be able to hopefully be able to raise the dividend again in the future, as we've done before. So it is, I think if gas prices are back over $3, you're right, we generate a lot of cash flow at those levels. And so I think right now we probably continue to pay down our debt. We continue to look for acquisitions that make sense. And at the appropriate time, it's going to make sense, I think, to raise our dividend again. Because we're comfortable with a higher payout ratio. And right now our payout ratio is probably around 80%. It was the reason we reduced our dividend is because the payout ratio was getting close to 100%. And I don't want to use debt to keep the dividend going. But I do believe that this business model, we should have a high payout ratio. There's no reason why we shouldn't be giving more back to shareholders, because we don't have to save for the contingencies of drilling more, because we're never going to be a company that's going to rapidly increase our drilling. We may increase our drilling. We may have some slight growth to our production, but it's never going to be a case of a large amount. At least I don't think that it's ever going to make sense on our model. But it is, but you also have to keep, it's helpful to keep a very strong balance sheet for acquisitions. And so we're very cognizant of that.
So with acquisition of Certus, you're increasing your exposure to oil or liquids, really. Do you see Pine Cliff's liquids weighting further increasing in the future?
You know what? I think all about, when we look at assets, it's really about how does this help us either sustain or increase the dividend. And so having NGLs and oil as part of the portfolio, I think makes a more sustainable dividend company. That's my own belief. I think if you're 100% on any commodity, it's very difficult to build a sustainable dividend because of the volatility of the commodity prices. So having multiple, quite often, as we're seeing right now, oil's over $80. That's a very healthy oil price. Natural gas is under $2. That's not a very healthy natural gas price. So, but yet we're at this, be able to still pay a dividend because of that mix of commodity prices commodities that we have in our portfolio. So I think we'll always be a natural gas company. I guess you should never say never, but from my perspective, I think the potential upside on the natural gas for the next decade, the next couple of decades, I think is very, very attractive as an investor. And that's at my core, that's what I am. I'm an investor. So I run, Pine Cliff, but it was really through the eyes of an investor. And I think we've set up ourselves very well, in my view, to take advantage of what's coming on the natural gas side. But the oil and liquids, I'm not a bear on oil prices. I think oil prices are going to remain robust as well. I just think the potential for natural gas to double or triple is quite probable. Whereas I think oil to do a double or triple would be less probable.
Where do you envision Pine Cliff Energy in 5 years?
Yeah, you know what? It's we've never really had a specific 3 or 5 year plan, although it's funny that you mentioned it, because we just were talking this at the board level, that we are going to do some more kind of strategic thinking. We've been a bit more reactive over the years. It was important for us to build that base of low decline assets, and we did that. The last couple of transactions we've done have not been low decline assets, not the traditional low decline legacy assets that we've built the company initially on. They were much more assets that gave us inventory, that gave us a bit more liquids exposure. We've been able to maintain a low decline through that. If I had to predict, I suspect we'll be bigger. I mean, that's always been our model. But it'll only if we saw transactions that that really make a per share basis. I mean, we're a small company on the global spectrum. I understand that we're $400 million enterprise value is not very big in the grand scheme of things. However, as a shareholder, at the company of this size, we have the critical mass to be able to generate a lot of income. We've already, in just a short period of time, paid over $70 million of dividends. We only started the dividend in 2022. That's pretty impressive for a company of our size. So I think the potential to continue to give back cash to shareholders will always attract a certain investor, like myself. I mean, we have a lot of high net worth retail and family offices that are shareholders. So I like that base of shareholders we have. I think, though, that we will, if I had to predict, I would suspect that we will have done more transactions. I don't know how big those transactions would be. I think our reach is maybe a little bit longer than people think it is because of who our shareholders are. I mean, an AECO, et cetera, that have been very supportive of us, I think would support us if we do more accretive transactions. So we'll see where it goes. But my goal will be to continue to do transactions that are going to be able to allow us to increase our dividend over time.